Okay, I would like to welcome everyone to the TMA Detroit. Welcome to the MCA Jungle, an analysis of MCAs, the problems MCAs often cause, and some potential solutions to those problems. For those on the call who might not be aware, MCA is Merchant Cash Advance. Thank you all for joining us. I'd like to thank our sponsors. You can see all of their logos on the screen. Without our generous sponsors, programs like today's would not be possible. Also, I'd like to remind you of some of our fun upcoming events. The Mid-America Regional Conference is going to be held in Grand Rapids for the first time, April 7th through the 9th. And then we are going to have an NFL draft watch party in downtown Detroit, April 25th. We have our annual award celebration May 7th and our annual golf outing in its 27th year on June 17th. So make sure you join us at those events. You can get more information on our website, turnaround.org/Detroit, and you can send me an email at detroit@turnaround.org. Today's presentation will be recorded. If you would like a recording or the slides, please just send me an email at detroit@turnaround.org. You can use the Q&A function to submit questions throughout the presentation. With that being said, we have three awesome presenters for today: Ken Yager, Karen Small, and Joseph Brown. With that, I will let them take it over.
All right, thank you very much. This is Ken Yager from Newpoint Advisors Corporation. I'm founder of the organization. Most of you are more familiar with Paul Shapiro, my colleague and Senior Managing Director with Newpoint in Detroit area. Newpoint very specifically focuses on small distressed companies, those companies that are, if you will, most often victimized by merchant cash advance situations, and why I wanted to be here today to help you guys understand the situation with my co-presenters. For this presentation, in order to take this topic apart and unpack it, we need to start with just making sure we all know what an MCA is and a couple of the touch points about that action. So I'm going to start off with our first slide and then hand it over to Karen and then to Joe, who are going to get into a lot more detail. All right, an MCA is, as we say, is a merchant cash advance. Here are some of the characteristics, and I'll try not to read the slides, but commentate as we go along. Acting through loan brokers, a very important feature that we're going to come to later, offer a lump sum cash of capital to struggling companies with little underwriting and within days or weeks. Some of you might recognize this is also a feature that might be described as online lending, payday lending, or if you will, fintech. Yes, they are very much all the same. Not every fintech is an MCA, but every MCA is likely a fintech. Purports to be buying an interest in receivables, important legal issue that Joe will get into later. Often a percentage interest in receivables that do not exist yet. You'll hear about future receivables or future income or future cash in some of the conversation. Recoups its capital through a series of automated daily or weekly ACHs. There are a few that will do monthly from a client's checking account, often in the same dollar amount every periodicity whenever they do it, which is one of the things that we'll talk about as some ways to find out if you've got an MCA lurking. Charges in implicit interest rate exceeds 80%. You might see a piece of paper that says this is a 15 or 25% loan, but when you get done doing the APR, you find yourself 80%, and sometimes that can be a generous version. Some of you may have seen recent articles where a group called Yellowstone was sued by the state of New York for an 820% interest, which is not totally out of the realm of things that do happen. Which is to say the withdrawals exceed the lump sum investment of 80%. This is something we'll be talking about. An MCA is willing to provide additional capital to often smaller companies that are desperate and cannot obtain alternative financing or quick enough at all. The old payrolls on Friday or payrolls tomorrow, what am I going to do? This is sort of where the victimization starts, or kind of a two-way street of accidents that we'll unpack here. It is often the smaller companies and sole proprietors that get whacked, but MCAs and their brazenness and their ability to be successful, even by the way they operate, which is I'll use my layman's term of illegal. They are they're crawling their way up to larger and larger companies, which I think for the TMA members is why this webinar is so important. This is not some isolated incident that's going to deal with some sort of pizza joint or some beauty parlor. This stuff is coming from middle market companies. It is largely unregulated, or it avoids and ignores all the regulations that it should, which is something that Joe will get into later. With that sort of colorful description of what is an MCA and why you might, or why they exist, I'll hand it over to Karen to take it a little bit further. Karen?
Great. Thanks, Ken. I appreciate it. Hi, my name is Karen Small. I'm from Commercial Finance Partners. We provide working capital alternative funding solutions to the middle market companies through direct lending and partner programs. We specialize in accounts receivable financing, such as factoring, asset-based lines of credit, and SBA loans. We're headquartered in Boca, Florida, and I'm in Michigan representing the Michigan Midwest region. So I appreciate the time and thank you for inviting me to be on this panel. So as a lender, as you know, MCAs can impact lenders. So why should we care about MCAs? If you are anywhere helping a client that is desperate in need of cash, it's imperative that everyone understands just how dangerous MCAs are. They sell speed. They sell speed over rate. They can have funds within 24 hours with just a few bank statements and an application. So other lenders, we take a little bit longer. We have a lot more due diligence, but unfortunately, MCAs sell speed. The borrowers with existing lenders should also know that doing business with an MCA will likely breach their existing contracts. And there's a quote here that I can't take credit for. Joe put this quote together about A cannot sell to B what A has already sold or pledged to C. His little quote is, he that sells what isn't his in buys it back or goes to prison. So I found that kind of comical. Thank you, Joe. Secured lenders or legitimate buyers of accounts receivable should also know that an MCA can hinder their position before they're even detected. They can interfere with lenders trying to refinance. They can interfere with M&A transactions, ideally causing a shortage in the availability, which ideally prevents the deal not to come to a close for a lot of parties, not only the business owner, but the advisor, the investment banker, and the lender. So a lot of work goes into this just to be short and not enough availability due to these MCAs. When you're doing business with an MCA, it's highly linked to a future bankruptcy, unfortunately. Doing business with multiple MCAs is typically leads to normal fatal to the business. MCAs are known for stacking. They stack their loans. I've seen companies with 2, 3, 6, even 8 stacked loans. And unfortunately, that just leads to insolvency and bankruptcy. If you have a UCC on file for the lenders out there, if you think you're a senior secured lender, you might want to try to rethink that again. MCAs can impact the UCC. I have MCAs has caused confusions with UCCs in the past, and I'm going to let Joe just expand on that when he gets to the legal matters later on in this presentation. And as Ken stated too, these MCAs are now attempting to move up market. I'm seeing them in more sophisticated clients and prospects. So it's important that team members they're going to start seeing this more and that they're aware of these MCA transactions. We can switch the slide. I have a case study just kind of want to share with the group. And then, so the deal background here is an architectural company. They accumulated around 1.1 million in MCA debts from 6 different MCAs. Unfortunately, the company had a top line revenue around 13.5 million. Their monthly MCA payment was approximately $120,000 or 11% of their revenue. Some of the challenges is, of course, high debt burden, major cash flow strain, collateral, and the other commitments were also in jeopardy from the prior lender, the working capital line, and of course, they had an existing real estate mortgage. And this company was just literally on the path for bankruptcy or insolvency. In this scenario, CFP, we were able to provide a refinancing solution that included refinancing with a term loan, consolidate all the MCA debts into a single, more manageable term loan over 10 years. Refinancing, with the refinancing, we put a line of credit in, major payment reduction, payments were reduced from around $120,000 to $17,000 a month, significant easing up the cash flow. But not all of these cases have a happy ending. This likely could have turned into a bankruptcy, could have resulted in write-offs, real estate foreclosures, and ideally, domino effect job losses for the employees at that company. But other stories I've seen out there, not necessarily do we have to be concerned about the MCA lender, we also have the MCA broker combined with MCA lenders. So this can just be a perfect storm to a prospective borrower. So I've seen, I had a factoring prospect come across my desk, and as a lender, we lost the lead to a not so high integrity MCA broker. So you got to watch out for these so-called sharks. The ask was only a $450,000 factoring credit facility, and it was going to pay off existing MCAs and provide them working capital at a more affordable cost. The company already had 3 MCAs stacked in place. They were charging around $12,000 a week and about $52,000 a month. If they were to go with the factor, we would have been somewhere around $2,000 a week and around $14,000 a month. So the factor could have saved the prospect over $230,000 in on average a 6-month window. But the broker was not providing full disclosure to the prospect as it pertains to pricing and how expensive. He was very aggressive with how he continued to push the MCA, and that factoring was just, not gonna fly. The factor many times is left educating why MCAs are just not a good fit, and that factoring is substantial savings, likely a quarter of the cost of MCA, but worth the due diligence wait. And unfortunately, the factoring can be such a substantial savings that the prospect now doesn't believe the factor. So I've come across that before. So in this scenario, again, the broker who brought it, his factoring commission would have been 15% a month of factoring revenue reoccurring for the life of the deal, kind of, 10 to 15 is kind of standard across the board. And the MCA broker was looking for 6 to 15 points. MCA broker stated that I can't send you this deal. 50% monthly recurring commission was just not going to work at all. In fact, the broker, because he just said, that's just pennies. That's nothing. He says he has a lifestyle he needs to live. And the broker actually stated that he likes to drink expensive wine and that 50% wouldn't even cover his monthly wine expense. So with that said, unfortunately, the MCA then convinced the prospect into staying with him, and the MCA loaned him, gave him another, overall the MCA broker, the MCA guy ended up just convinced this factory company to stack this one more MCA on top, unfortunately. So, overall the MCA broker just, again, in this scenario, they're not all like that. I caution there's very integrity brokers out there. But in to this particular MCA broker, he falsely represented the borrower for his own cash in pocket benefit. In theory, the broker was selling speed to buy his expensive wine. So that's an unfortunate scenario. There's so many more. I'm sure Ken and I and Joe could go on for, but wanted to share those, just a couple of the war stories in the trenches, and just some ways that MCAs can come in and backdoor advisors and lenders. So with that said, I want to pass this off to Joe.
Can you advance to slide 1? Thank you, Amanda. So hi, everyone. My name is Joseph Brown. I have been a commercial insolvency lawyer since 1998. I spent most of that time working in law firms in Chicago. I moved to Michigan in 2018 because my wife became a professor at the University of Michigan. And I'm going to be starting a new job at a small firm in Plymouth, Michigan called Falzone and Grisco in a couple of weeks. So that's who I am. I've spent most of my career dealing with insolvency issues, bankruptcy issues, factors, MCAs, and workouts of those products. So I'm going to be talking today as a lawyer about the legal characteristics of MCA products and how you, as a professional counseling someone who may be exposed to MCA risk, how you can get an MCA to back off once the MCA gets their hooks into your client. So I'm speaking to you as one professional trying to teach another professional about how to avoid MCA risk, how to deal with MCAs. And then I'll also be talking a little bit with relevance to current lenders to a particular borrower who have or should have some idea that their positions are being ransacked underneath the table by MCAs, and what they can do to prevent that and what they can do to spot that risk. So let's start. I mean, as most of us know, or who have experience dealing with MCAs, they work like anacondas. They come onto the scene. They offer a desperate company who's in need of immediate short-term cash, a particular financing. I call them loans, and we'll get into why that's the case. They start sucking money out of the checking account almost immediately through automated ACH withdrawals. And what happens is, after the first immediate sugar high of that lump sum that they get from the MCA, the cash withdrawals quickly make the company cash anemic again. And at that point, the MCA will reappear on the scene and say, you know what, I can get you another little lump of cash, not nearly as large as the first lump, but still a lump. And what we'll do is we will weave and roll over all the unpaid principal, interest, all the junk fees, the finder's fees, all of it. We'll just roll that into the principal of a new note. And I call them notes, and we'll get into why I call them notes. MCA would never call them a note, but that's what happens. And then, of course, the ACH withdrawals go up. The immediate sugar high from the second position isn't as strong as the first sugar high was. The company is getting anemic with cash even faster because the cash drawdown is faster. And lo and behold, what does the MCA do? They say, you know what, I can help you out again. Here's a third position. And so what you'll find is, over time, the client is becoming weaker and weaker and weaker, and the tendrils and tentacles of that MCA are now wrapping more and more tightly around that company. And then what will happen is, one MCA may exit the scene, but the client, in order to pay them off, has to do business with a new entering MCA who basically acts like the fourth MCA rollover, and that note keeps getting higher and higher and higher. The control of the MCA over cash and over the company becomes more and more strong. And the actual ratio of what these MCAs actually put into the company with respect to cash, as it compares to the size of the note, gets further and further and further out of whack. I call that the anaconda, and that is a classic MCA technique for exerting control over a weak company. So I have done a lot of fighting with MCAs, a lot of fighting. And I've also done some representation of MCAs, and we'll get into why that's the case and how it came about. So I know a fair amount about them. I've seen under the hood, so to speak. They've taught me about their business models, and just doing war with them in at least a half dozen cases over the last 5 years, prominent cases in some cases, I kind of have an understanding of how their product works and where the weak points are. So I can't cover all of it, but I'll leave you with 3 big ideas today. 3 big ideas, 3 big legal ideas that can help you in what your goal should be, which is, in my opinion, to get an amicable divorce from the MCAs, to get them to go away. And the way you do that is, you don't tell them that you're not going to repay them back their principal, but what you do is you say, I'll give you back your nut. It'll be payment plans that are on my terms, my time schedule. I may even give you a kicker and allow you to get a little return on your capital, but we're going to do this my way, under my time schedule. And in that way, you convert what would have been a 500 or 600% juice loan into just normal functional capital. That can be the goal. If you tell an MCA that you're just going to take their money and there's nothing they can do about it, they will go to war with you forever. But at the other hand, you just can't abide by their contracts either, because that's also a disaster. So what I found is the happy intermediate ground, as I've said, is a kind of forced renegotiation of the paper in which they get their capital back, but not much more. That's a way of doing this on the cheap and most effectively, in my view. So what I suggest are 3 big legal ideas that you need to know about. And the first one is this. MCA money is debt. It is a loan. 9 times out of 10, 99 times out of 100, It is debt and a loan under controlling law. And there is a multi-factor test that I can get into for determining what is debt and what is a purchase. But almost all MCA products are so completely drastically excessive to one end of that spectrum that it's a no-brainer. It's almost always debt. It's almost always a loan. And why I say that has to do with this chart in front of you. This chart depicts the way that lawyers, when they're being honest, and bankruptcy judges and people in power at courts actually analyze financial transactions. What a bankruptcy judge does, for example, is draw the transaction on paper with boxes and arrows showing the entity, showing the cash flows, cash flow being king, showing title flows, showing claims flows, showing property interests that move, showing sequences. And then what they do is they erase all the words and the labels that other lawyers or other accountants have previously placed on that diagram. And they analyze that transaction for what's really happening rather than the labels. And that's called substance over form, substance over labels. So what you see here is on the right-hand side, an actual secured lending featuring accounts receivables. And on the left-hand side, you'll see what is supposedly an alleged true sale conducted by an MCA in which they are buying, or they purport to be, they claim to be buying receivables or future interest in receivables. And what you'll note is, if you squint anyway, or if you're nearsighted, those diagrams look exactly alike. Only the labels are changing. And that is why it's very, very easy for a court analyzing these transactions to throw out the labels that have been supplied by the MCA and use the quack like a duck rule, which is if it looks like a loan and if it behaves like a loan and if the cash flows are loanish and if the risk allocation after the transaction is the same as before, we're going to call this a loan. And by risk allocation, I'm talking about recourse, which is to say, if you are a buyer of accounts, but you are not taking any risk if any of those accounts flunk out, if you can just point the arrow back at the account generator, the client, and say, make good on this account, it was a lemon, then you have recourse. And because you are not taking the true risk of ownership, you will not be deemed to be an owner under most controlling laws in all 50 states. So this diagram is why most MCA products under controlling law and well-decided cases, and of course a case could be decided incorrectly by someone who doesn't understand what's going on, but most well-decided cases by sophisticated judges will find under most factual circumstances that an MCA product is a loan. It is debt. It is not, as the MCA claims, a purchase of an asset. And you will hear MCAs fight to the death about how they are purchasers and they are not lenders. And one thing you can do in your negotiations with them is just pop that bubble right away. Hit them early with the fact that they are a loan, they are lenders, they have a debt. You know that. You're not going to play along with the fantasy that they've purchased something. And it just shows right from the beginning that you're someone not to be messed with, that you've gained sophistication, that you know how this joke is told, and you know what the punchline is ahead of time. Because it will take the wind out of their sails remarkably if you can just show up front a remedial sophistication as to what these transactions are and how a court will analyze them.
And Joe, I think someone could quote, without quoting case numbers, that there are judges who have opined on this.
There are a number of judges that have opined about this nationally. I've written papers about this. I'm not going to get into legal citation. This is something called a true sale analysis. A true sale analysis happens in all kinds of financial products, not just involving MCAs. It involves factoring. When I was cutting my teeth as a younger attorney, we did a lot of securitizations. We had to write extensive true sale analyses of those documents. And almost every court system in the country and all the federal courts have an 8 or 9 factored analysis that they use to parse out what is a sale, what is a sale of accounts receivable, and what is a secured transaction in which the borrower retains title but gives a collateral interest to the lender. And we don't have to get into it. In the Chicago area, it's called to my mind, the LaSalle test. There's a case out there, a great case called LaSalle that just lays this out, and I can give you a citation after the talk about these 8 factors. But first amongst those factors is always recourse, which is if you're a buyer, but you're never exposed to risk if one of these accounts that you supposedly are buying goes wrong, if you can just offshore that risk back to the business, you're likely not a buyer. You're likely not a buyer. So again, what does showing that an MCA is a lender and not a purchaser get you? It gets you, the professional who's trying to make these people go away, a hell of a lot. It gets you application of all the laws and all the rules that apply to loans. And that's a lot of stuff. That's usury in many states. When you're charging 800% in any state, even states that believe that big people are big people and should be allowed to borrow at any rate they want, once you get to 800%, you're running afoul of many usury laws. You're obviously a lender. What does that mean? The bankruptcy laws apply to you. That's a huge deal because once you're a lender and the bankruptcy laws apply to you, negotiations can take place with the safety net underneath the negotiations. Okay, we haven't filed bankruptcy yet, but this is what would happen if we did. And would you like that, Mr. MCA? Would you enjoy it if we filed bankruptcy and there was a clawback of all the payments to you as preferences, and if the automatic stay applied to you, and if there was a fraudulent conveyance analysis done of your position, and if if 506 analysis was done? Because what Rule 506 does under the bankruptcy code is says that a lien is only a lien to the effect that it's in the money. So if you have a lien for $500, but your collateral is only worth $50, you're unsecured to the tune of $450. And you can see how this would affect an MCA who is stacked, because their collateral, since they're sixth to the party, is often 600 or 700% underwater. They don't have any collateral, which means under 506 of the bankruptcy code, they are unsecured lenders inside that bankruptcy proceeding. And as we all know, unsecured lenders are very unhappy and have reasons to be very unhappy in bankruptcy proceedings. They're the first to take the loss. They're almost always going to be wiped out. That's always the way it's been. So that's my first big takeaway here, and it's the biggest thing you need to know. Write this down, 109. Under section 109 of the UCC, the UCC applies even to the purchase of accounts receivable, which means that even if that MCA happens to be that 1 in 100 MCAs who's special and actually is a purchaser of accounts and actually can show that they're a purchaser of accounts, the UCC still applies to them, which is why, paradoxically, many people ask, well, why is it that I'm a factor in MCA, I have to file a UCC 1? That's why. It's section 109. And I can tell you that the UCC is a dry read and it's hard and you can bang your head against the same paragraph for 2 days trying to find all the defined terms and get to the bottom meaning. But one of the funniest and lightest reads in the UCC is its discussion of accounts receivable financing, where the UCC just throws up its hands and says, we don't know what these transactions are. We don't care. You can call them a loan. You can call them a purchase, but the UCC is still going to apply to that transaction. So that's idea number 1. These things are loans. They are debt. And once you show that, and once you can prove that, and it's very easy with stacking, a whole bunch of laws apply, and you can use those laws as threats in a negotiation. The second big takeaway I'd have for you folks is that not only are these MCA lenders, not only is their product a debt, but it is an unsecured debt. They have nothing. They normally hold nothing. That is always the case with stacking, because as we've discussed, stacking involves an MCA showing up to a party where there are already 5 or 6 lenders and other MCAs who are claiming a watertight first priority security interest or purchase interest on absolutely everything. And then the MCA still has the chutzpah to say that somehow they have bought that thing or they have taken accounts receivable collateral interest in that product. And it just cannot be the case. And it's just a matter of common sense. You can only sell one thing one time to one true new owner. After that, you can't sell it again. This is the Brooklyn Bridge all over again. And it's the same thing with collateral interests. I mean, technically, you can pledge the same accounts receivable as collateral over and over again. But those junior lenders who would supposedly be taking that collateral in a junior interest, which is 500 or 600% underwater, have no collateral at all. So they're either fools or liars when they say that they have taken a collateral interest. And the courts will view them as such. And the courts will say, you know what? What you're saying about this transaction makes no economic sense when we actually analyze these boxes and arrows, which is why it's so often very easy to recharacterize, which is a fancy word for asking a court to say, you know what, judge, we don't care what this paper says. We don't care what their claims are. We want you just to say, to rule that these guys are unsecured lenders. And if they're recharacterized as such, that's what they've got to live with. All of their fancy contracts with all their make-believe words just go poof in that court. So could we go to the next slide, please? So this is a UCC1, as I've said before, even true purchasers, even purchasers of accounts who are really, really not lenders, and that's a very rare thing in the MCA world, even they have to file UCC1s. And why? Because of section 109 of the UCC, which says that we apply to everything, including purchases of accounts receivable. And what you'll notice here are two telltale signs that this has been filed by an MCA. And it's actually in the collateral description, which is at the bottom in all caps. And what it contains is a very kind of poetic, threatening, colorful description of collateral, which you'll never, ever see in any serious UCC filed by JP Morgan or Morgan Stanley or any white-shoed lender, which is that it contains a legal theory and a threat to anyone who would dare assert a purchase interest or a collateral interest in the very accounts that the MCA is now claiming. And so this is evidence of wrongdoing, obviously, because what the MCA is basically saying is, even though we're sixth or seventh to the party, and even though we're lending or purchasing stuff that's already been claimed by others, if you dare do to us what we're doing to everybody else who came before us, you're going to be guilty of, and I read here, tortious interference, and we're going to sue your pants off. So this is, if you can find it, if you know what you're looking for, again, when you find your client is doing business with an MCA, the first thing you need to do is get a lien search performed, a UCC lien search. That can be done through a service, that can even be done homemade, online, often working through a Secretary of State's. You develop a pecking order, a mental list of all the people who have a claim on the accounts. You, using just first-in-time analysis, figure out who's in first place, who's in second place, who's in third place. And you'll often find out that a UCC file like the one you're seeing here is in sixth or seventh place on accounts, which means, number one, they're out of the money. They're unsecured lenders. But number two, because they've used this language in their UCC, they have basically admitted that what they themselves are doing is tortious interference, and it's evidence that you can use against them. Secured lenders, Mr. Banker out there, this is a piece of evidence that you can use to sue that MCA for tortious interference under its own admission. Mr. Borrower, who's trying to get the MCA to go away. The MCA thinks you're a rube. The MCA thinks you're a victim. The MCA thinks you don't know what you're doing. Pull this publicly available UCC, show them the lease search, ask them why it is they're in sixth place, third place, fourth place, whatever place, except for first place with respect to recourse to these assets, these accounts receivable. Ask them why it is they think that other people who do what they are doing is tortious interference, but somehow what they're doing supposedly is just fine and right. So the other telltale sign, and this is less of a harbinger than most, is that this has been filed by an agent, in this case, CSC. Now, it's not wrong or improper or a badge of impropriety to use agents to file your UCC1. Some banks do it, but I would say this, almost all MCAs use an agent and never use their real name when they file UCC1s, because among other things, there are these brokers out there who are fishing around for potential clients, and it's very easy to do lien search results and find all the lien search results filed by a particular MCA that hasn't disguised its identity, and thereby discover its customer list. So MCAs are extremely secretive. Again, the fact that that an agent here has been used is, it's not a sign of wrongdoing at all, but I would say that almost MCAs use agents. It's the language below with the tortious interference that screams, this is a stacking MCA. And it's a very useful piece of evidence for you to have, and it's a weapon for you to use if you know where to look for it and how to use it. All right, so we've talked about how MCA products are almost always loans or debt. And we've talked also about how very often they are unsecured debt. They've been stacked, that there's stacking that's happened. So let's go to a third major point, which is, what do you do with this information? What tactics do you use? What language do you use? What do you need to know about this culture in order to, if your goal is what my goal would be, which is get them to go away without making them go to war, give them back their nut, or 90% of their nut, or 101% of their nut, but certainly not 600% of their nut. How do you get that result, which is good for your client, good for the MCA, cheap, and doesn't have you paying guys like me hundreds of thousands of dollars in court to litigate these things? So what do you do? The first thing, obviously, is you have to have that lien search, and you have to understand the lien search. The lien search is the alpha and the omega of this analysis. What I would say is this: there is a culture here and a subculture, and it often involves a certain area of the country where the MCAs often operate from. It is a cowboy culture. It is a macho culture. It is a wannabe mafioso culture in some instances. And these guys will act like tough guys. And when you call them up and you suggest that you want them to go away and you're potentially willing to do them a favor and give them back their money, but not much more, they will yell and scream at you and threaten you and tell you that they're going to put you out of business. And what I found, every one of us as a professional has to take their particular tack and go home that night feeling comfortable with their own behavior. But what I found is you have to yell back. You have to find your inner table pounder. Even if you're a scholarly, nice person who doesn't believe in the F word or swearing or yelling or any of it, you have to find your inner warrior to deal with these folks. Because I have found that's what they respect. If they yell at you and you're meek, it shows them that all their theories about you to begin with were true. That you're a rube, that you don't understand your rights, that you're a pushover, that you're desperate. If you yell back, even once or twice, especially if you use these arguments, which are sophisticated enough, they will gain respect for you and you can begin to have a conversation. And I would say this: I've done it to such a successful degree that they've actually hired me, which says something. This is a culture that respects aggression. This is a poker playing culture. And so you need to realize you're not dealing with JP Morgan when you deal with these folks. Some of these guys will front that they are powerful bankers, that they belong to a multi-million-dollar organization, and they're going to snuff you out and put you out of business overnight with all their powers and all the draconian remedies in their documents. But it's very often, to return to my poker analogy, a massive bluff. Many of these are very small companies. Some of them cannot do their next deal until they get their capital back from the previous deal. Some of them are living out of their mama's basement and are just entrepreneurs. Some of them are also ISOs or brokers who also have a $100,000 business on the side. But if they lose that nut, that operating capital, just once, they are done. So you're dealing with a myriad number of players here, but you need to realize that many MCAs, and I would think at least over 50% of them, are small, weak companies that are basically preying on other small, weak companies. And so you need to know who they are so you can use that weakness against them, just like they are trying to do to you. So what I would say is this: in this environment, if your goal is to get them to go away without giving them incentive, spend every last dime that they may have in litigating against you and trying to put you out of business, the goal here should be a walk away in which they get their nut back, or at least most of it. That will give them incentive to walk away because they do not want to litigate. They do not have the institutional ability at times to litigate. They don't have the competence to litigate. Litigation involves, among other things, discovery. They have no ability to answer discovery. They have no files that they can find. They have no real way of paying lawyers. And normally they hate paying lawyers most than almost any other business out there, including yours. So the threat of litigation is something that they find unsettling, even though they're always going to be threatening to sue you. You need to understand who they are and what their real incentives are. The other thing you need to understand is default in this environment, payment default, is your friend. And that can happen naturally because your client just flat out runs out of money and the checking account runs dry. And so the straw that they are using to suck that money out of the account starts slurping because there's no money left in the account. Or it can be a default that happens artificially, perhaps because someone advised that it happened. And how could that happen? Well, it's very easy. You can just swap out the checking accounts. You can tell your customers to make payments to a new account at a new bank. And all of a sudden, that checking account that's infested with ACH withdrawal permissions is running dry. And of course, they will threaten to sue you, and they may sue you. But at that point, you have an invitation to a negotiation. And even powerful MCAs don't want their names in the paper. They don't want to go to court and have a ruling made that their particular paper is not a true sale, which may often happen. They have every incentive, despite all of their huffing and puffing, to avoid litigation. And they will hit you with all kinds of threat about how they have a power of attorney and confessions of judgment. And that's all true. And it could very well be that they're going to file those documents. It could very well be that you do go out of business. I can't promise you anything. I take no responsibility for what would happen if you actually follow this course of advice that I'm giving you. But what I'm telling you is that when your client is dealing with MCAs, the risks of just letting it play out and of doing nothing are actually greater than the risks of taking some sort of assertive action to recut the deals. It's your risk. You're big boys and girls. You'll have to decide for yourself what your appetite is. But if you have an appetite for trying to save the company and pushing back, these are the tactics that I found often work. And as I said before, my goal, recut the deal, let them save face, let them get enough of their nut back that they now have an incentive not to sue you, and maybe it isn't even 100% or par, maybe it's 90%, because they think of 90 cents on the dollar returned quickly, much better than fighting it out in some foreign court. Most of them are East Coast entities. They don't want to be litigating in Iowa or Michigan or Indiana. They think of that as a sideshow. Some of them have never even been here. They don't want to come here for depositions. They don't want to go to trial here. And so they are willing very often to roll over and recut the paper if you give them incentives to do so. And if you show enough knowledge and sophistication to let them understand that you know who they are and that you see through them. So you're going to have to, in my opinion, be a little aggressive here. You have no other choice. Your client is already dealing with an MCA. If your client were in a better position, you wouldn't be facing this to begin with. So there's already trouble there. It's just a question of how you deal with it and which poisons you pick, frankly.
Hey, Joe, as you're going through these, I want to throw a scenario at you that's come across our desk, and because I think there's a shock and awe moment here, even for an advisor who's in a company. We had a case at Newpoint about a year ago where there was an MCA stacking situation. And there were 6 MCAs, 5 of which who fell into the category I would say, we're gonna get somewhere with you. They were the milder or meeker that Joe has described. They kind of took their fangs out. Fangs came out pretty quickly. But there was one in particular, and this is just a thing you should know about your client, when they get their loans, one of the typical things that an MCA will ask for is 3 months of bank statements. One, now they know where you're banking, all the places you bank, because they'll want everything. Number 2, they now know who you send money to and who is sending money to you, depending on how your bank formats this information. Some of them have very sophisticated software that will find the emails and mailing address and snail mail addresses for those companies. So we had a case where 5 of 6 complied within 72 hours of moving the bank account and having the account bounce, if you will. We got the screaming and the yelling within in 24 hours, but in 72 hours, every single one of the client's customers and oddly their vendors was sent a letter of redirect that their all money funds should go to the MCA they had first right for refusal. So Joe, that's kind of just, that's another one that's going to kind of catch you. It's going to catch your breath if you're trying to negotiate with somebody, but it's real. These are things that MCAs will.
I have dealt with letters of redirect. It happens, I believe, under I don't want to dazzle you with numbers, but I believe it's
Yeah.
406 of the UCC. Letters of redirect are kind of funny because I have found that they most often don't work. Imagine yourself, you're an account, you owe a company an account, and you get this strange letter in the mail that says, hey, you know what? We want you to redirect all your payments somewhere else, or we're going to sue your pants off because you'll be directly liable if you don't abide by this after receiving this letter.
Yep.
I mean, I shouldn't. Here's what I did one time, and I'm not saying it was necessarily Boy Scout tactics, but what I did was simply send a new letter to those same people saying, these people are weasels. They're trying to rip us off. Don't send them the money. And what is that MCA going to do at that point? Sue 75 companies in the Illinois area or the Wisconsin area in local courts based on these bizarre letters? So letters of redirect can be more powerful tools, I would say, in an upmarket situation where everyone involved is hiring attorneys and everyone knows what the law is. But when you're dealing with grandma's bakery and these people have known grandma for years, and that's usually a typical client for an MCA loan because grandma has to make payroll, her clients and her customers are not going to be very impressed when a firm from New Jersey says, don't pay grandma anymore, pay us. They often just won't do it. I'd say 75% of them just won't abide anyway.
Right.
And then if you add on the extra kicker of making the phone calls and saying, hey, we're dealing with these weasels, please just have some patience with us. Don't worry, this is all going to go away. I mean, the success rate with us was zero. They got not a dime out of their redirect campaign.
Yeah. The issue you guys will run into, Joe's absolutely right. The issue you run into is the bandwidth while you're suffering to, okay, you guys are holding money. Maybe you want some of that money to show up for payroll.
Oh yeah, they will take it as a payment holiday invitation. I mean, that's
Yeah. Now, the other thing that Joe's brought up about changing bank accounts, I want to make a quick statement here too, because it ties into this letter of redirect. You do the redirect of the bank account before you notify the MCAs that you want to talk to them, because the first thing they will do is don't always, but they'll send that letter of redirect. And for everybody else that is with the local friends and family of a vendor or of your client, they're likely not to. They act like Joe said, maybe a little pause, but no damaging actions. Banks, particularly national banks, large banks, will send that to legal, and legal will notify Treasury to freeze the account.
right.
And so everyone's money is locked up at the bank, and the bank will also lock up. It varies, but 2x of the amount in the letter. So if the MCA says we're owed $100,000, they'll lock up $200,000 at the bank and say, we'll figure this out later. Because they don't know what's going to happen with the litigation and who's going to pay the fees for all this stuff. So they just kind of protect themselves. So you've got to get this out, typically take it to a bank that is not New York State regulated.
Correct.
Or has a branch associated with New York. Very important small detail. And then make sure that you do that before, because they will find the bank. There's the only person that can really screw with you, or because of their processes, not because they don't like you, they just have rules. Sorry, Joe.
I had promised a brief comments to the senior secured lenders who are out there who starting to think that their client isn't acting very nicely recently, and they're wondering if something's wrong and there's a weakness there and what's going on. I was a banker for a while, worked in-house at a large bank in Chicago for a few years, and I actually watched this go down. We used to go to Young Banker College, in which all the bankers would be taught the basics, ABCs of banking as they came in from their undergraduate degrees and had to realize that they were now going to be working for a living for real. And one of the things they're taught is get that UCC1 on file and you're bulletproof. Get that UCC1 on file. Bankers go through their careers thinking that if they get that UCC1 on file, they're good to go. And it's not really true. A UCC1 will perfect a lien against a wide variety of assets, but that doesn't mean it's the trumping lien. And with respect to cash, the trumping lien is actual control. which means that if you are a senior secured lender and you think you've got a lien on everything, including cash, but you've done nothing to control cash, that MCA has now found a hole in your defenses, can come in, suck all the cash out that it wants, and it can do so legally under the law, because the law strips liens that come out of checking accounts from all liens that might previously be held. And I won't dazzle you with numbers again, but that's 332 of the UCC, 9332. So bankers need to be aware that cash is special. They need to do extra things to protect it. I mean, I've seen a case where the bank that actually was having his lunch eaten was also the bank that had the checking account. So every day they could have logged on without doing any heroics at all and seeing that, oh gosh, here are 17 days in a row in which $3,019.22 has been pulled from this account. Why is that? That is a telltale sign that their lunch is being eaten. But unless bankers are educated as to what MCA products look like and how they behave, they don't know that their lunch is being eaten. And they may think that the UCC one protects them from any loss of cash. And all they got at the end of the day is an invitation to a lawsuit where they can try and sue the MCA to get it back under, you guessed it, tortious interference or one of those, which in poker terms is, I would think, weak as a pair of fours. No one respects tortious interference lawsuits, especially if you're a bank that should have known better. So you need to control cash to begin with, which means the only way you can protect a dollar is to make sure that it never leaves that checking account getting into the MCA's pocket to begin with. You have to prevent here. You can't just retroactively claim a lien. And you also need to have a certain amount of client education, because if you're dealing with a weakened client, you need to educate them and say, look, you're going to be approached by MCAs, or maybe you have. These are actually lenders dressed up as someone else, but they're lenders. If you do business with them, not only are you going to hurt your business, but you're also going to violate all of our documents and ruin our relationship. You get that, right? You need to have your bankers with enough acumen to reach out to their clients and educate them about what these products are, so that the bank's lunch or the senior secured lender's lunch isn't eaten to begin with, because there's nothing you can do after it's happened. And with that, I pretty much conclude my remarks. It's 12:53. So if we will have discussion or Q&A, we have a little time to handle that.
All right. Well, we do have one comment, Joe, that's come in. Has there been any legislation introduced to regulate MCAs? You want to take a first stab at that?
I haven't followed. I mean, this MCAs for many years, for about, well, first of all, MCAs came onto the scene about, I would say, 10 years ago. And for a long while, no one knew what they were. And oftentimes they pass themselves off as if they were factors, but they're not really factors, because factors actually buy existing accounts. And these guys were just stacking like crazy, lending into accounts that made no sense. No one knew who they were. They were wildly unregulated. Even factors were unregulated for a long while, and still to some degree are. There's an International Factoring Association, which does a lot to try and keep it that way. Right now, I've heard of legislation that has been attempted to address these situations, but what is happening more and more is there's just now action by local states attorneys generals to target these guys. People now know enough about them. People now know what's wrong with their positions. People now have an understanding that they're there. And so for the first time, there's a real awareness of who they are and that they probably need to be regulated in some sort of way. I mean, the most famous example has just come out a few weeks ago. It's Yellowstone out of New York being targeted by the New York Attorney General, who used the same law that she used to target the ex-president of the United States, which is a specialized law designed to, basically target companies who are, how would you say it, highly aggressive predators in their particular arena. And I won't get into the politics of whether the Trump situation was appropriate or not, but I can tell you that the law seems to have been tailor-made for this particular environment.
Yeah. So just adding on to Joe's comments, there were some rules. The state of New York has, where this all emanates from, or most of the activity emanates from, had some very bad actors that were supporting this industry, that were really on the inside of the government, and they've been able to dash that with a few regulations that were put out in the last 3 or 4 years. So people are chipping away at it after that decade of anonymity that the industry lived with. Then as Joe has pointed out, the attorneys generals in various states, who some are more sensitive to the usurious rates of charging, and some of the stories of entrepreneurs who've had their lives wrecked, have taken some actions. The only bad news there is, as they are sweeping the if you will, the internet and scouring for these companies and pushing the MCAs to the side, the MCAs have struck back and have pointed at the factoring industry. And I think a little bit of, I don't know how much the ABL industry is affected by this, but regs and regulations, particularly in states like the state of New York and the state of California, have started to come out in a way that are actually kind of tilting everything backwards a little bit against the factoring industry. So there's a lot of angst right now over this, not only from a industry standpoint in the wild, wild west, but also even the regulatory side. The cavalry's arrived, and it goes kind of down to what Reagan said: we're from the government, and we're here to help. It's not going quite the way the factoring industry had hoped.
Yeah, I mean, my IFA friends have often said that the MCAs like to stick really close to the true factors.
Mhm.
The reason they do that is for political cover, that
Yeah.
a regulator really has to be very nuanced in parsing them out. One group that does one thing and has one product, and one group has another. And the MCAs try and confuse and muddy the waters as much as possible, so that any particular regulation or proposed regulation that would gore their ox would also do tremendous damage to more legitimate industries, we'll call them. And in that way, they gain the political cover of those industries. And when those industries push back and do their own lobbying, guess who gets inadvertently benefited? It's the MCAs themselves.
Yes.
I can say that some of the mechanisms that MCAs use to collect out their positions, for example, New York Confessions of Judgment, they were really abusing New York Confessions of Judgment and that particular mechanism. And so New York did change its laws to sever that tool, so that you can no longer just blindly file confessions of judgment in some small county in New York and immediately have an enforceable judgment there that you can then domesticate wherever you want. So as for national legislation, I haven't seen it, but I haven't really been paying attention to it. My focus has always been, the case in front of me and the particular facts in front of me, and obviously the lien search result. If I can leave you with two things today, it's section 109 of the UCC, and please do a UCC lien search result, which will show you what's happening here. It's like playing poker where you can see all the cards. So do those things.
Great, Joe. Thank you. And Karen, would like to give you the last word? Any data point or one lesson or thing you want them to walk away with?
Sure. No, I appreciate that, Ken. I mean, just in conclusion, these MCAs just have a domino effect on our overall middle market business and the economy. I mean, nationwide, with their exuberant high rates, along with the MCA brokers' lack of compassion, and just truly feeling the impact of these loans, what can result in just, they can put these companies out of business. These business owners become unemployed. Then the company's unemployed. Then the company's employees are out of a job. MCA lenders, non-MCA lenders are taking potential write-offs, and it impacts nationwide, that so many people just don't realize. Dealing with small business owners, an MCA lender could just truly impact just the person who answers the phone at any small business, unfortunately. So yeah, we need to make this stop. And what can we do to protect our business owners, the entrepreneurial dream?
Thank you, Karen. I'll second that one. All right, with that, we'll conclude our webinar.
Thanks, guys.
Great, thank you.
Thank you.